The big question right now, what will the next stage of this economic cycle look like?
Since there's so much uncertainty out there right now, should you play it safe and stock picking and go for the good old-fashioned blue chips? Well, Kelli Hill is a portfolio manager at Ashfield Capital Partners, which is $3.1 billion in assets under management. Kelli, welcome.
Thank you very much.
Okay, so let's set the stage. Are the blue chips still the blue chips, the solid, slow-growing, dependable stock names?
I think you want to still focus on large cap growth, the big names, the solid names. Names that have, over the last 2 quarters, really spent a lot of time getting their balance sheets in order. You saw that in the second quarter where we saw strong profit margins for most of these large cap growth companies. The other thing that is good about these large cap is they have international exposure. So if you believe in continued global growth, that's exactly where you want to be.
So are we talking about your father's blue chips? Is that when we say blue chips?
No, I don't think it. That's a great statement. I don't think it is your father's blue chips.
Or your mom's.
Or your mom's, exactly. I think it's certainly in the industrial area, companies focused on infrastructure that have been able to continue to enhance productivity. But I also think it's technology. I think technology lends itself to increased top-line growth and also productivity. And again, it leads you to some of the large cap names.
So if you're uncertain about how this economy is going to sort itself out, this is the best strategy to go by?
I think so,
if you're
yes.
an average investor.
If you're an average investor, first of all, you want to be invested. Second of all, you want to be invested in equities for the long term. We think the best opportunity is in what you would consider traditional equities, large cap growth.
I know you're not recommending these names, but let's talk specifics. The large cap growth names would be?
Oh, for example,
IBM.
IBM, absolutely. I think, again, you're starting to see where productivity is in services, is in, to a certain extent, early in this economic recovery, hardware and demand for hardware at many of U.S. companies.
So they're strategically placed when this does start to come back around.
Oh, not only strategically placed, but they've also, as I mentioned earlier, been able to put their balance sheets in order so that any top-line growth that occurs, and we are very optimistic about seeing some top-line growth in the third quarter, that it just drops right to the bottom line.
Kelli, this is interesting. Data showing that low-quality stocks are actually supporting the market right now. So why is that, and do you expect this trend to reverse then, given the first part of our discussion here?
Oh, absolutely. And if you think back, monetary and fiscal policy are acting just as they should. And early in the economic recovery, with the increase in liquidity in the equity markets, you do see that lower quality equity rally off the bottom. But as it turns to fundamentals and earnings growth, that's where large cap really takes off.
So this 50% run off the March low being supported by the lower quality, that's over and done with at this point. We're going to see a sea change here.
Yes, and also the difference between, you've seen small cap outperform large cap. We think that will reverse itself as well.
But Kelli, you've been optimistic about the market since the end of last year. Why? What were you seeing that other people weren't?
Simply that things do get better. And that you want to be thoughtful about how you position yourself.
But you're also saying that, given the cyclical nature of things, that a little patience here is required, given the enormity of the problems we're facing.
Oh, absolutely. And I think that what's important is that individual estimates are probably going to surprise on the upside.
Right.
On an overall, there may be some disappointment.
We were talking about this out in the studio before you came on here live, that there's this huge discrepancy. Bloomberg News did the story today that the stock analysts are predicting S&P's earnings next year to rise 25%, which is actually 10.9 times faster than the Economist survey for GDP. So why that discrepancy? Is that 25% earnings growth even feasible?
Well, I think it is if you look at it from a global perspective. If you look at it, sectors including industrials, basic materials, and energy, which comprise, I think, nearly 30% of the S&P. Yes, I do believe that you can see that kind of growth. On the other side of it, though, and this is kind of the wild card, is the consumer. And we haven't seen real evidence of consumer spending. What'll be interesting is what we see back to school.
And you mentioned you like technology, so you talk about the questions about the consumer. That's got to be a concern to you, no?
Well, the consumer in developing countries, so whether it be China or India, things like Qualcomm, where you're seeing increased 3G technology being adopted, the service and also increased services, whether it be here domestically, netbooks, e-books, or navigation.
And we were seeing that year to date, Qualcomm up almost 28% right now.
Yes, but we still think that they have set themselves up and taken the opportunity several years ago to position themselves to be very, very competitive, and so we think the growth is really multi-year.
And what about Amgen?
We like that again. What we're looking for are companies that have a sustainable competitive advantage. We think they clearly have a competitive advantage in the oncology area. They have 5 phase 3 drugs in trial currently. We also think that there is a lot of potential with one of their most prominent drugs today.
Do you have any concerns about the administration's current legislation regarding healthcare reform? Does this factor into your outlook for healthcare stocks?
It does on some of the device and equipment side and supply side, where we think there may be some pressure to profit margins. But again, we're looking for companies that have a sustainable competitive advantage that can continue to grow earnings.
Kelli, the amount of liquidity that's been pumped into the markets, what's that going to do for low-quality stocks?
Well, I think it's already done a certain amount, and they certainly have rallied off the bottom, both in low quality. If you look at sort of how companies are rated by S&P,
right.
You've really seen the outperformance in sort of the B-C area. Again, I think that as we move forward and business starts to expand and the need to access the credit markets in order to continue to grow, companies that have a lower rating have a little more difficult time accessing credit. So we think that, again, quality companies will supersede the lower quality companies.
And in our remaining 30 seconds, Kelli, how would you characterize the sell-off of the last couple of days? I mean, is it just a little bit of a correction while we regain the bullish?
Well, I think there have been some fears in growth. You saw it in the orders number. Also, the fact that China may have to step in and increase interest rates. We don't think that's going to happen. We think Chinese authorities are very much in line with a global economic recovery.
Kelli Hill, portfolio manager at Ashfield & Company, where you have a saying, which is never underestimate the consumer. Thanks so much for coming on. We appreciate it.